Hi everyone, let's look at a question from May June, paper 1 for accounting. Right, if you look at this question, a statement of comprehensive income, that is the income statement and current liabilities, that's not number 6. No, not number 5. That's not number 5 because 4 is inventory, 5 is current assets. Right, sorry, it's just current assets. And just looking at current assets, I'm not quite sure what it is that they're looking at, but in current assets you have note number 4, 5 and 6, that is inventory, trade and other receivables, and cash equivalents. Those are 3 notes that you find. I choose a description from column B that matches the term in column A. Then all that, right? Then independent auditor, right? What is an independent auditor? An independent staff of a company who sets up no total and no expresses and unbiased, right? So that will be E. That's an independent auditor. And then capital employed, right? That is total ordinary share equity and non-current liabilities. That's capital employed. Then current liabilities, debt to be settled within 12 months. That's current liabilities. Financial assets, investment assets, fixed deposit over a 3-year period, right? So that will be that. Those are the concepts, right? Simple and straightforward. Starlight Ltd 1.2. The information relates to the financial year ended 28 February 2023. The company trades in electrical items. I'd refer to information B. Calculate the value of the closing stock of light bulbs on 28 February 2023 using weighted average method. I remember there are 3 ways of calculating the value of closing stock or stock valuation methods, right? First one is first in, first out, then weighted average, the one that we're given here, then specific identification method. I should be familiar with the 3. And it's of recent, since they split the papers, that you find that in question 1 or in financial statements, they ask you to value stock using one of the methods of stock valuation. So you no longer get away with it just because there's one question on stock valuation, find that they'll bring it back into question 1. Then refer to information B2. Calculate profit or loss on disposal. I'd calculate total depreciation for the year. Then complete the following statement of comprehensive income for the year ended 28 February 2023. Then current assets section of the statement of financial position, that's for the balance sheet. Right, reading along. It's always important just to read everything. Extract from the pre-adjustment trial balance on 28 February 2023. Right, balance sheet account section, loan per bank, you're given opening and closing balances. Then vehicles, you're given opening balances. Then so the opening balances would be 2022. So these are opening balances. Then equipment, you're given opening and closing. Right, accumulated depreciation on equipment 360,000. Then you're given accumulated depreciation on vehicles as well, that is opening. Then fixed deposit per bank 320,000. Then trading stock 2,669,800. Debtors control 645,000. Provision for bad debts, you're only given the opening. Right, then bank debit balance, right? If it's a debit balance, it's an asset. Then SARS income tax provisional payments, right? So these are provisional payments. Then sales 17,850,000. Cost of sales 10,200,000. Salaries and wages, the question mark. Commission income 85,900. Rent income 89,700. Audit fees 155,200. Directors fees 2,015,000. Sundry expenses 219,760. Bad debts 16,200. Interest on fixed deposit question mark. Asset disposal, cash received on vehicle sold 91,500. Then information B adjustment. Adjustment and additional information. A physical stock take count on 28 February 2023 reviewed 2,774,800. Stock on hand, right, 2 million reviewed 2 million, right, so that's a stock count. Reviewed 2,774,800 stock on hand. However, this figure excludes the closing stock figure for light bulbs. Note that the weighted average method is used to value the light bulbs. Details of the light bulbs are as follows. Right, units then priced and total. You almost only doing stock valuation, you always get this type of a table. Stock on 1 March 2022, that's 8,000 units at 52 rand each. Then purchases, that's for the year, 47,000 at 74 rand each. Then available for sale, that's 55,000, which is 8 plus 47, right? That will give you 55,000. Then carriage on purchases at 27,500. Then stock on 28 February 2023, 1,700, and they have no value. Okay, right, then moving along. Fixed assets and depreciation. Vehicles. An old vehicle was sold for 91,500 on 31 November. Right, so an old vehicle was sold on 30 November 2022. The amount received was recorded, but no further entries were made. So they only recorded the amount received, but other entries were not made. So no other entries were made. Details of the vehicle sold. Carrying value on 1 March 2022, 104,000. Depreciation 20% per annum on the diminishing balance method. Is 20%. Depreciation on the remaining vehicles, 145,200. So you're given already the depreciation on the remaining vehicles, right? They calculated the depreciation of the remaining vehicles. That means you don't have to stress about anything, right? What you need to do is just to record the depreciation that was for the vehicle that was sold, right? Equipment is depreciated at 15% per annum on cost. New equipment was bought on 31 July 2022. The orders are owed a further 38,000 for the current financial year. I received 9,000 from the insolvent estate of a debtor, Billy Kroon. His debt paid 80%, 80 cents to the rand of his outstanding balance. So you received this amount, and it was only a representative of 80 cents to the rand for his standing balance, right? So how much was written off? Those are bad debts written off, right? The money received was recorded. The balance of his amount was still must still be written off, right? So that was recorded, and we need to write off the balance. The provision for bad debts must be increased to 25,000. When they increase, that means it's an expense, right? Director fees. The company has 2 directors who were appointed in 2019. A 3rd director was appointed on 1 October 2023. The directors all earn the same monthly fee. Directors' fees paid during the financial year have been recorded, but one director has already been paid for March and April is now a common adjustment, right? It's a very common adjustment. Right, rent income includes the rent for March 2023 received from the tenant. The monthly rent was increased by 1,170 on 1 January 2023. So you received rent for 1 month in advance. Right, so you need to calculate the deferred income. Right, loan per bank. Interest on the loan capitalized has not been recorded. Fixed monthly repayments include interest has been paid and correctly recorded for the financial year. Interest on the loan must amounts to 60% of the monthly repayments. So interest on the loan capitalized has not been recorded. Right, so fixed monthly repayments including interest have been paid and correctly recorded for the financial year. Interest on the loan amounts to 60% of the monthly repayments. Right. Income tax for the year was calculated to be 858,140. Right. So that's the end of the question, because what follows is question 2. Right, let's look at answering the first part of the question, which is calculate the value of the closing stock on 1 of light bulbs. Right, so the value of closing stock. Right, so what we have, we're using this table here. Right, so the value of closing stock, remember you're using weighted average. Right, so what you're going to do, you're going to calculate the weighted average price. Right, so how do you get the weighted average price? Right, is the total, right, value of goods minus any returns plus carriage divided by the total number of units minus any units that were returned. So for this one, what we have available for sale, that's what we're going to use. So instead of adding your already given, that will be 3,894,400 3,894,000. Right, plus carriage of 27,500, all divided by total numbers 55,000. Right, that's 3,894,000 plus 27,500, all divided by 55,000. You get 71. Right, since we're using average, that's the average, the weighted average price per unit. Right, so to get your value of closing stock, you say this weighted average price per unit times the remaining units. So value of closing stock that's 1,700 multiplied by 7130, so times 1,700, that will be 121,210. Right, that will be the value of the closing stock for bulbs. Right, we're given by this. right? So you calculate the average price. That's why it's called weighted average. So you calculate the average price. So just remember, on calculating average price, if there are any returns, you remove the value of the returns, you remove the number of units of returns, you add carriage, right, onto the total amount. Then you work out your average price, right? So that is that, right? We're done with the first one. Then second one is calculate profit or loss on disposal. And profit or loss on disposal, and we're using the information on the vehicle. Right, an old vehicle was sold for 91,500 on 30 November 2022. The amount received was recorded, but no further entries were made. Details of the vehicle sold. Right, carrying value. Right, on 1 March 2022, it's 104,000. Depreciation 20% per annum on the diminishing balance method. So the vehicle was sold on 30 November, that is 8 months into the year, right? So when you're calculating value, profit or loss on disposal, right? The vehicle was sold for 91,500, right? Carrying value, opening carrying value, the beginning of the year was 104,000. Right? Depreciation 20%, diminishing balance method, right? That's reducing balance method. So to see whether it was profit or loss on sale, what we do, we calculate depreciation up to date of sale, right, which is current year depreciation is 104,000 times 20% times 8/12. That gives you 20% times 104, that's 20,800. So 20,800 times 8 divided by 12. Right, this should be 9, not 8. Right, so that's 20,800 times 9 divided by 12. That you get 15,600. Right, so that means carrying value on date of sale, that is 104,000 minus 15,600. Right, which gives you a carrying value of minus 104,000. That's 8,400. Right, how much was it sold for? Selling price 91,500. Just double check. Yeah. So profit. So you make a profit on a sale, any fixed asset above its carrying value. So profit on sale, that will be 91,500 minus 88,400 plus 91,500. So you made a profit of 3,100. And that was profit that was made. Right, okay. Then moving on, calculate total depreciation for the year vehicles. Right, so for vehicles, right, we have this already, that is calculated here, 15,600. disposed 15,600. Then you are given the other one, depreciation on the remaining vehicles 145,200. And on closing, remaining 145,200. There's no working that you need to do there. And then equipment is depreciated 50% per annum on cost. New equipment was bought on 31 July. Right. So we check on our equipment. Right, equipment. So we have 82,000. Right. So for the opening balance, calculate for opening. Right, that is 774,000, and the rate is 15%. Times 15%. Then on the new equipment, that is 822,000 minus 774,000. All this multiplied by 15% times it was bought on July 30 July. It was bought on 31 July. So we calculating depreciation for the time it was in use. So we say 31 July, that was the last day of the month. So we say August, September, October, November, December, January, February. That's 7 months. Right, I almost got it wrong there. That's 7 months, right? Because we're not calculating disposal, we're calculating depreciation. So you calculate from the date of purchase going forward, not from date of sale or purchase going backwards. You do that when you're doing disposal. I calculate from date of sale going backwards until the beginning of the year. Right, so this will give you 774,000 times 15%. That will give you 116,000. Then 822,000 minus 774,000. That's 48 times 15%. Right, times 7 divided by 12. That's 4,200. So the entire, that will be 4,200 plus 116,000 plus 145,200 plus 15,600. So the total depreciation will be 281,000. Let's start double checking calculations to make sure that I got everything correct. 774,000 times 15%. Now this should be 116,100. What are the other ones? I calculated them earlier. Then for the new one, that's 822,000 minus 774,000. That's 48,000 times 15%. and times 7 divided by 12. That is correct. So the only thing that was wrong was that one. Right, so going to the next question, the income statement. Right, so you're given sales, cost of sales, and gross profit. So you have calculated other incomes, and other income commission is already have been put. Rent we know we have an adjustment because we're told. Right, our rent is 89,500. And minus what, because we're told here in the adjustment. Right, rent income. Rent income includes the rent for March 2023. Rent from the tenant for March 20 received from the tenant. The monthly rent was increased by 110. So what we need to do is we need to calculate how much was rent before increase. So that will be 89,500 minus the rent was increased on 1 January 23 March, that's 3 months. Right, minus the increase, the component of the increase 1,170 times what? 3 or divided by what? And rent was paid for 13 months because your year ends on 28 February 2023, but March was received as well, so that basically means 13 months. So divided by 13. So calculating 1,170 times 3 gives you 3,510 minus 89,500. That will give you 85,990 divided by 13. Did I copy the figure correct? It's 89,700. Right, 89,700. Right, so that's 89,700 minus 3,510, then divided by 13. So this will give you 6,613. Right, to get the rent after increase, so we need to add, because this is before this rent here. This is before the increase of 1,170. So to get the increase, that's plus 1,170. That's plus 1,170. That will give you, so rent after increase is 7,800. So 7,800 will receive for March, which you need to deduct, so minus 7,800. Then profit, we calculated this one on sale of vehicle. It's 3,100. We don't have any other income. Normally you check your provision for bad debts, but provision for bad debts, we're told that they increased, right? So there's an increase in provision for bad debts. You check your trading stock as well. If the stock count is more than the balance in your balance is given, that will be an income as well, right? Then you check other incomes, commission income, fee income, and other income, but commission income they input it for us already, right? So calculating rent, this is 700, not 500. That's 89,700 minus 7,800, that's 81,900. Right, then other incomes, that will be 81,900 plus 3,900 plus 85,900, which is 170,900. Gross operating income, that will be gross profit plus other incomes, that's plus 7,650,000. That's 7,820,900. Then salaries and wages. If you come to salaries and wages, we're not given, I don't see an adjustment for salaries and wages. That's question 2. Capital income, tax, director's fees, audit equipment, no, not given. So we have a question mark for salaries and wages here, and don't have an adjustment, so we'll probably is an adjusting figure. Then audit fees. Audit fees, we have 155,200. I understand we owe auditors. Auditors are owed 38,800. That's an accrued expense. 800. Then director's fees. Director's fees, it says here the company has 2 directors who were appointed in 2019. Verified third director was appointed on 1 October 2022. Right, the directors owe in the same monthly fee. Directors' fees paid during the financial year have been recorded, but one director has already been paid for March and April. That means there is a prepayment as well for the director's fees. Right, so we need to remove that. So how much is the total director's fees? $2,015,000. I'll do the working right here. So we got 2,015,000. Right, how many months was the directors paid for? Right, the directors were basically paid for 2 directors, 12 months. The other director was appointed in October. So you count October, November, December, January, February, that's 6 months. Right, plus the 2 months that were paid to the other director. So basically the number of months will be 12 times 2 plus October, November, December, January, February plus 5 plus the 2 March and April. So this will be equal to 12 by 2 is 24. Right, plus 5, 29. So that will be a total of 31 months. I'd get the monthly fee. What you basically say, remember these 2 months are for March and April. That was paid after for the next financial year. Then these 5 months are for this director who was employed from 1 October. Then these 12 months by 2 are for the director that started right from the beginning of the year up to the end of the year. So in total is 31. So now to calculate the total, the amount that we need to deduct from the director's fees, right, that will be 31, 2,015,000 divided by 31, that will give you 2,015,000 divided by 31, that will give you 65,000. Then that was the monthly fee. One director was paid for 2 months. Right, so to get how much was prepaid, that will be 65,000 multiplied by what? By 2, which is equal to 130,000. Right. The shortcut of it all is, because all you want is for the financial is this month, which is 29. So if you want to speed up, but you maybe later on, because it depends what the question, if you're going to complete the note number 5, right, you still need to calculate this 130,000, right? But if you're not, right, basically you need 29 months, right? 12 by 2, 24 plus 5. So if you say 29 over 31 times 2,000,000 and 15, you get the exact answer that we're going to get now. So here it's director's fees is 2,015,000 minus 130,000. Some expenses were given. Paid debts. Paid debts, we have this that we're going to work out now. Right, the paid debts that need to add there, right, because the person received 80 cents in every 1 rand, right, and the total amount they received was 9,000. So I want to calculate the 20 cents. So to find out the 20 cents, basically say 20 that was not received over 80 that was received times 9,000. This will give you 20 divided by, that's a quarter, 2,250 I think, divided by 80 times 9,000, yeah, 2,250. That's the additional bad debts. Or what you can say is calculate the 100%. That will be 100 over 80 times 9,000, sorry. So 100 divided by 80 times 9,000. This will give you 11,250, and then we say 11,250 minus 9,000, you get 2,250. So this will be the shortcut. Right, so 2,250. Then our bad debts, what's our bad debts figure here? 16,200. So that will be 16,200 plus 2,250. Depreciation, we calculated it to 281,100. Right, and then the next one, provision for bad debts. That's an increase. That's we're told provision for bad debts for previous was 21,020. We were told it should be increased to 25,720. So that will be 25,720 minus 21,020. Right, then trading stock, deficit, that's 2,969,800 minus notes 2,774,800 minus 121,210, the one that we calculated right at the beginning, this one here, right? Because remember they said this excludes the value of the bulbs, so we need to add the value of the bulbs there, right? So that's all about expenses. Let's see if there's another expense. Bed debts covered, sundry expenses, rent, in stock deficit, depreciation. I think that's all. Right, let's calculate the values. That's 2,969,800 minus 2,774,800 minus 121,210. So this is 73,790. Then 25,000 for bed, provision for bed is 25,720 minus 21,020. That's 4,700. Then 16,200 plus 2,250. That's 18,450. Then 2,015,000 minus 130,000. That's 1,885. 1,885,000. Then 155, 200 plus 38,800. That's 194. Right, then our salaries and wages. So salaries and wages, basically we're going to say total operating expenses minus the expense that we calculated. So that's 4,894,900 minus 194,000 minus 1,885,000 minus 219,760 minus 18,450 minus 281,100 minus 4,700 minus 73,790. That's 202 million. $2,218,100. That's our salaries and wages. Right, then calculating operating profit. Right, operating is gross operating income, right, minus operating expenses. So that's 7,820,900 minus 4,894,900. So you get 2,926,000. Interest income. Right, interest income, interest on fixed deposit, question mark. Right, then we have fixed deposit 320,000. Let's see if we have an adjustment. That's for fixed assets. And that's for loan. Right, so we're not given anything to calculate the interest on fixed deposit. But in our question, we are given the bottom, so we can work our way up. Right, we can work our way up. Right, okay. So net profit before tax, we add the 2 to get net profit before tax. So that's 2,002,500 plus 858 plus tax 114. So this will give you 2,860,614. Then they said here, interest on the loan capitalized has not been recorded. Fixed monthly repayments, including interest, have been paid and correctly recorded in the financial statements. Interest on the loan must amounts to 60% of the monthly repayments. Right, if you check, you're given opening and closing balances for the loan. So your loan started at 690, and now it's what, 524,400, right? So basically what it means here, it's the difference between the two is the repayments. Remember, as we pay the loan, right, we deduct the full amount that we repay, right? But on the bank side, they capitalize the interest. Right, so the interest portion will be capitalized. That's why I find most of the times your loan statement balance that you get from the bank and the balance that you have according to your ledger accounts is not the same, because the bank was capitalizing interest and yet you're deducting total repayment, but on the total repayment it was inclusive of interest payment. So at the end of the day, the bank will remove the interest component and only reduce your loan amount with the net, not the gross. Right, so here they said 690,000 was opening, then 504 is closing, right? So if you come to the question, so if you come right at the bottom here, right, so they said 690,000 is the opening, then 524, 400 is the closing. So this will give you a total repayment of 690 minus 524, 400. That's 165,600. And the question said interest on the loan amounts to 60% of the monthly repayments. So that's basically 60% of the total repayments. So for us to get the interest on loan, that will be 165,000 600 times 60%, right? Because that was the total payment. So 165, 600 times 60%, that's 99,360. So your interest expense is 99,360. Right, then profit before tax. Profit before tax will be 99,360 plus net profit before tax 2,860,640. This will give you 2,960. So 2,960,000. Then your interest income will be operating profit minus profit before interest expense. So that will be minus 2,926,000. That's 34,000. Right. So that will be your question. Let me just double check on the last calculation. If my figures are correct, 690,524,400. Yeah. Right. The next question. Current assets. Right, inventories. That will be 2,274,800 plus 121,210. That will be your inventories. Right, there's nothing that you need to add there. That will be your straight inventories because you don't have any consumable stores in hand. I trade in other receivables. I remember when I said earlier they want 130,000. Right, so here we have trade debtors. Let's look at the trade debtors. That is 645,250 minus this amount here, right? This 2,250 minus, so that will be minus 25,000 720, which is the current provision for bad debts. Then plus the 130 prepayment, which is this one. This prepayment for the directors, the amount and expense paid in advance. Then cash and cash equivalent. So we have total assets, current assets being 7,605, let's see if we didn't leave anything, especially things like taxation, SARS income, right? It says here SARS income provisional tax payment. So the payment that we made amounted to 875,000. Then tax that was calculated amounted to 858. That means they overpaid tax, so that becomes part of your current assets, trade and other receivables. So that will be plus again here 875,000 minus 858 140. Of course, what happened is total payments for SARS provisional payments with 875,000, but the actual tax calculated was 858,140. So when that happens, right, you paid more provisions than the actual tax. So that means SARS owes you, right? So at the end of the day, when it comes to that, it becomes a tax asset, right? A SARS income tax asset. So if you pay less than the actual taxation, it's a liability, right? So that will give us 645. Let's first calculate this one. $875,000 minus 858,140. That's 16,000. $16,860, right? Plus 645,250 minus 2,250 minus 25,720. I hope this figure is correct. Plus 130,000. That's 764. 140. Then this will be equal to 289 something. Let me just calculate it. That's 2,274,800. Was it 274? 774. You see, that's 774. $2,774,800 plus 121 to 10. That's 2,896,010. So to calculate your cash and cash equivalent, that will be 7,605,150, which is the total assets, minus 2,896,010 minus 764,140. So this will give you 3,945,000. So that will be your question on income statement. It was fairly a straightforward question that you could easily answer how it is.